Very good morning, everyone. Very good morning. I hope you all are doing good. So, welcome back again in the editorial analysis series. Is audio video all set? Let me know quickly. Audio video good? All set? All right. So, here today we have this editorial from Economic Times. Okay. If you have been following the newspapers, you would notice that right now, since budget is to be presented or annual financial statement is to be presented in July, so there are these kind of articles that what should be the government doing, what should be the budgetary policies, what should the government target, right? All these kind of things. So much of the articles are like this kind of articles which are there in the newspapers. So that's why I'm picking up more relevant ones. Why? Because only speculating what should the government do is no use for us, of no use for us. What will be useful is what comes in the budget finally, right? We can say government should do this, should do that, but actually what comes into the budget will be important for us. Then onwards the editorials will be much interesting to discuss, right? So this has been picked up today from your Economic Times. So the article says, as you can see here, NRIs of the world keeping on depositing. So you can understand from the title only that NRI deposits in India are rising. This is something which you already know. We have discussed this thing in RBI annual report that India is constantly witnessing inward remittances, right? And if you can tell me which is the country from where India is witnessing the largest amount of remittances. Do you remember the country we have discussed? Is it Mauritius or is it Singapore? Yeah. Any answers? Singapore? Sure? Yes. All right. So, very good, right? So, you know that this is a trend going on. This article will talk about what are the reasons why NRI deposits are, rising in India. So, this revolves around this trend. Okay. So, it would be somewhat new analysis, and hence I gave this title to the PPT, NRI funds residing in India. So, now NRIs, although not residing in India, but NRI funds are residing, they are preferring to reside more in India, right? So this is the thing. Starting with the discussion. So here you can see NRI deposits in India are surging. So this is the news. They have been surging. This is a good sign. Also, it is leading to more funds available to India. And one more thing, if you remember, the foreign currency reserves are also continuously rising in case of India, right? So we are very satisfactory on that front as well. NRI deposits in India are surging as the factors defining the risk reward trade-off are broadly positive. Now the author of this editorial talks about something which is called as risk reward trade-off. So the author is saying NRI deposits being surging in India has something to do with the trade-off between risk and reward, which is positive in case of India. Now what happens is, when you place your deposits, okay, first before talking about these analysis and NRI deposits, before doing the analysis, I want you to be aware of NRI deposits. What are the NRI deposits? So you know who are the NRIs, right? Non-resident Indians. Non-resident Indians. These definitions of NRI, PIO or OCI. Now if you know, in 2015 only, via the Citizenship Amendment Act of 2015, OCI and PIO got merged with each other, right? OCI, Overseas Citizen of India, and PIO, Person of Indian Origin, they got merged together, okay? So now you have OCI, Overseas Citizen of India. OCI card holders are there, and then you have non-resident Indians, NRIs. Who defines them? So there are definitions. The Foreign Exchange Management Act, 99. Also the Income Tax Act. Okay, both define. So income tax also defines NRIs, OCIs, PIOs for the purpose of taxation. So income tax also defines them. Also you have Foreign Exchange Management Act which defines them. Okay, I would tell you this is a good topic to have understanding about. So this playlist or these videos are available on this channel on YouTube only. So if you search CA-IIB exam, right? So CA-IIB mein there is BFM. Okay, BFM. In the CA-IIB BFM series, I have taught these topics. You can go to those lectures. You can try to understand what are these definitions if you are interested in, right? What are the different kinds of accounts? So when we talk about the NRI deposits, broadly there are these three types of accounts, NRE, non-resident rupee, okay, NRE, NRO, rupee account, and FCNR. It is in foreign currency. Yes, FCNRA, right? So NRE, NRO, FCNRA, these accounts. You can refer to those classes. I have in depth told you I have discussed with you the differences in NRE, NRO and FCNRA account. Okay, so it would not be feasible to discuss these entire chapters which took 2 to 3 classes in this 1 hour class, right? So I ask you rather to go to those videos and you can learn about these accounts in detail. You will be able to differentiate, okay, that these are the differences between NRE, NRO and FCNRA account. Yes, NRE and NRO are kept in Indian currency or rupee, and FCNRA, foreign currency non-resident account, FCNRA is kept in foreign currency. Okay, which foreign currencies? Which are freely convertible or which are there in use in the international trade. Okay, so US dollar is there, Japanese yen is there, British pound sterling is there, Australian dollar is there, Canadian dollar is there. So all these foreign currencies are, you can keep your deposits in FCNRA account in these currencies, and NRE, NRO are to be kept, to be maintained in Indian rupee or Indian currency, INR. Understood, right? So this is just a glimpse, just a basic understanding of this thing. You can go and see the differences between these accounts, also the definitions of NRI, PIO, OCI as per the FEMA Act and as well as the Indian Income Tax Act. Okay, so you can go and refer to those classes. Now, since we have seen, so these are broadly the types of deposits which we have. Now, NRI deposits in India are surging, and the author is saying factors defining the risk reward trade-off are broadly positive. Now, what happens is when you deposit your funds, you try to judge whether it will be more rewarding or it will be more risky, isn't it? So whenever you want to place your excess funds which are lying there with you, you try to assess the risk. Is it risky to invest in somewhere? Is it risky to deposit in into somewhere? Or is it more beneficial to invest in some country? Right? All these things. So the author is saying that this risk reward trade-off, you have to compromise in between two things. You cannot go with reward and risk simultaneously, right? Either you will get reward or you will get risk, or it will face risk, isn't it? So there is a trade-off, but the author is saying that this trade-off in case of India is positive. It has been positive. Why? You know very well. We have completed the RBI annual report. In the entire discussion, we have seen Indian economy being very strong as compared to the major advanced economies rather, isn't it? So you see there is rising growth forecasts, positive growth outlook for India, Indian banking system being strong as compared to other advanced economies, Indian financial system being resilient, vibrant, more liquid, more regulated, more supervised, offers more of rewards than the risks. Are you getting my point? That's why the author is saying that these, risk reward trade-offs have been positive in case of India. Understood, right? Now, the next point which the author talks about is that the pandemic which hit the entire world, the pandemic has to do something with it. What does the pandemic has to do? So, the pandemic had reset households' saving patterns in favor of less risky bank deposits. This is something which has favored India in terms of incoming remittances. How can you relate this point? You all know very well that what happened during the pandemic, there was volatility in the entire financial system, right? Be it stock market, share market, be it banking system, capital market, money market, any of the markets, right? So, there was volatility. Now, due to that volatility, it became riskier to invest in those securities or assets. After Corona, what we have learned is you have to have safer deposits to meet any unprecedented circumstances like the pandemic, which can arrive at any point of time, isn't it? So, what pandemic did to the households, what the pandemic changed in the household pattern of saving is that they now started preferring to keep their deposits, keep their funds into safer avenues rather than risking the funds into more volatile markets. So, they rather chose to place these funds into Indian bank deposits or the NRI deposits which are there, isn't it? So, it shows that banking system is resilient in India. Not only the residents of India, but the non-resident Indians are also showing confidence in Indian financial system. So, this behavior of going for more safer kind of deposits has stemmed from the pandemic time. Understood, right? So, you know that deposits are far safer than the stock market, share market, all these investments. Investing your money into deposits or placing your money into deposits, bank deposits is much safer than investing in these markets, right? So, this is a behavior which was a result of pandemic uncertainties. Are you able to connect these things? Yes or no? Yes. So, this is one of the contributors. So, you see pandemic has led to rising remittances in India, and this is very much good for say this is good for India's image in the international level, as non-resident Indians are also showing their confidence into Indian banking system, and they are looking at the entire world or other financial markets and banking markets of other advanced economies or banking systems as more volatile. So, that shows that somewhere the prudent regulatory framework of RBI, the continuous efforts, there have been, if I say surgical strike, that would not be incorrect. Past 10 years or last decade has witnessed surgical strike by financial market, banking regulators, say RBI, SEBI in India on these regulated entities or supervised entities. This has been a successful surgical strike, isn't it? Agree or not? You would agree, right? Which has resulted into banking system being more vibrant and resilient, more strong. Agreed, right? So, these are certain dots which you need to correct. Pandemic has not affected only the healthcare system, it had these kind of effects as well. So, this is the initial thing which the author talks about. Now, the NRI population overall had relatively even incomes during the COVID disruptions, which kept inward remittances strong. Moreover, the author is saying that the NRI deposits or these NRI people, they have earned a relatively stable incomes. So their income has not seen so much of fluctuations. That's why you see, since then only NRI remittances in India have been on a positive trend. This is another point, right? Yes, we can say. So this term, why did I use this term surgical strike today? Has a reason. So there was this article, I think it was in Business Line or Business Standard. I think it was in Business Standard today. So it used this word surgical strike. Although the article was not so relevant, that's why I didn't take it in the analysis. It was not relevant, not at all. But these words were good, you know, constructive surgical strike. But this has resulted into banking system being more strong in case of India. That's why you see, given these global volatility is ongoing, India is still managed to, you know, decide its own repo rate inherent to the Indian economic condition. If you remember, we have discussed something. If you remember, the recent MPC meeting which was held, RBI governor has stated that our decision is not very much dependent on the US's Fed Reserve decision. That shows that your economy is now looking towards your problems only. We have been able to make our banking system so strong that we need not look at the outward fluctuations to decide for our own banking system. We have our internal challenges which we need to consider upon first. So that's a good sign. That's why yes, okay. So I have got certain questions. Let's discuss them. First is saying FDI is different from remittances. Yes, there's a difference between investment and remittance, isn't it? Try to understand this. That's why I asked you, I also discussed remittance word earlier. If I ask you, where do we keep remittances? In the current account or in the capital account BOP? Tell me. Where do we record the remittances in BOP? Where do we record remittances in BOP? In current account or in capital account? Current account or capital account? So remittances are recorded in your current account. Now in current account, under which head? Under, you know, transfers. Under transfers. So under current account, yes, very good, current account, transfers. So in current account you have trade of goods and services. Also the invisibles, which is the service, and transfers. Now what are transfers? These are one-sided payments. So remittances are being sent to India, or say being deposited in their accounts with Indian correspondent banking system, but it is not something paid to Indians for which they have worked. So remember, there are two kind of, I will discuss everything. There are two kind of incomes, factor income and transfer income. Whenever we talk about national income accounting or GDP accounting, we only take into consideration the factor income. What is factor income? The income which you earn against an economic activity, when you have performed certain economic activity which has contributed to, say, certain production, that can be of goods as well as services. But when you receive a payment without any contribution to economic growth, you have not performed any job for that. It is just, you know, a grant, a gift, a donation, a remittance. So, for example, there is a family residing in India and the NRI sends this money to his family residing in India. That is a remittance only. It is not an investment. It has been sent for the family's monthly expenses, managing monthly expenses. What is investment? It is creating assets. It is leading to economic activities. That is the difference. So yes, there is a difference between investment and remittance. I think Singapore say we have received the highest remittance, if I am correct. Even if I'm not correct, you can go and check this, because sometimes these facts, they just slip from the mind. So as far as I remember, Singapore is the country from where we have received the highest remittances, not FDI, okay? But you can go and check for this, okay? So I hope you have understood FDI and remittances are two different things. So remittances are transfers. FDI is investment. Investment, creating assets, creating income, generating income. All right. So this is the thing. Now we were discussing that NRI population has received even income. That's why they are able to deposit more in India or with Indian banking system. Now, steady movements in interest rates and exchange rates have also made NRI deposits more rewarding. Further, the author says, what all are the reasons apart from these which we have discussed? After the pandemic, we have seen steady rise in the interest rates. Can you relate to it? Why? Also in the foreign exchange rates. So remember one thing, as I told you, when you go and read about the differences in these accounts, NRE, NRO, FCNRA, FCNRB, right? These accounts, so you will see that foreign exchange rate fluctuation do not affect these accounts directly. If you see all the features which I have told you in those classes, CA, IIB, BFM, NRI correspondent banking series, you can find it there on the YouTube. So we have discussed that they are not very prone to foreign exchange fluctuations. Then what affects it? The interest rate fluctuations. You see, after the corona pandemic, we have gained momentum. Indian economy has been able to revive. With growth comes what? With rising aggregate demand, because government has intervened and government has increased its expenditure. So with rising government expenditure, you see aggregate demand rising. And you, all of my students, now you know by heart what happens when aggregate demand rises. What happens? Tell me. I'm very much sure you know these chain reactions now, because I keep on repeating them continuously in my classes. What happens if aggregate demand rises? What comes along with growth? Just tell me in one word. What comes along with growth? Inflation, isn't it? So what is the thing which is always there along with growth? Inflation. You cannot have growth without inflation. Yes, very good. Inflation is there. So when there is inflation, what do you expect on the part of interest rates? To rise or to fall? To rise or to fall when there is higher inflation? What do you expect the interest rates? You expect them to rise or to fall? To rise. Very good. Now when interest rate rises, you know what happens? All the related key policy rate rises, the other interest rates also rise. Now rising interest rate is an incentive to deposit your money into the banking system, because it increases your reward for the fixed deposit, for example. Now if you talk about these accounts, NRE, NRO. So in NRE account, if you see, that can, if I'm right, that can be opened up as saving account, current account, fixed deposit, term deposit, right? So you see, directly rise in interest rate incentivizes these NRIs to place more deposits in FDI in form of fixed deposit in India to earn more interest, and that too is more safer than investing in the volatile stock markets, isn't it? It is a win-win situation for them. One more thing, remember, these funds placed in NRE, NRO, they are non-taxable, remember. So this is another big advantage to them. If you see the features which I told you, I have discussed in those classes. If you look at those features of NRE and these related NRI deposits accounts, you would see the funds kept there are exempt from the income tax, from the wealth tax. Also the interest accruing to that fund is also exempt from taxation. So isn't it a win-win situation to place these deposits? So I think this is also one of the reasons which is attracting NRI deposits in India. They want to indulge in tax planning maybe. पैसा ही पैसा, yes. So I think NRO has tax provisions. We will look into it. But NRE does not have tax provision. So I will confirm it, okay. NRE is tax exempt. NRE is tax exempt. NRE में wealth tax तो नहीं होगा. Also interest is also exempted from tax, okay, in NRE account. We will check about the NRO as well. You can go and see those classes, what all are the provisions. So these are certain provisions which are also incentivizing for NRIs, right? Understood? Okay. Understood? So yeah, need not get confused, as I told you. NRE is exempt from taxation, okay. These are the things. So here you see steady movements in the interest rates incentivizes these people to deposit more with the Indian correspondent banking system. Now why am I using this word correspondent banking system again and again? Because you know they cannot directly open the accounts with with that much access what you have to the Indian banking system. There are these nostro and vostro accounts. So this is known as, you know, correspondent banking system. Banks in India have their correspondent banks. Bank in some other country has authorized dealers or correspondent banks. They open these accounts, NRI deposits. Okay, so this correspondent banking system, nostro account, what is vostro account, loro account, all these are also discussed in the corresponding banking classes of CAIIB BFM. You can go and read about these concepts. It will help you only, okay. So this is the thing. I hope you have understood that rising interest rates are also one of the reasons for attracting more NRI deposits in India. You should remember this. One of the reasons it is. Now moving ahead, this was further aided, the author says that this was further aided by temporary easing of risk provisions by RBI on such deposits. What happened is, you know, although right now recent trend is that RBI is being more strict to regulatory and supervisory norms of these regulated entities, but there was a time after the pandemic to pump in liquidity in the banking system. RBI somewhat eased the provisioning norms, okay, on such deposits. What are risk provisions? You all know that. What are risk provisions? So we have discussed the provisioning in case of project finance in one of the editorials, right? So provisioning is in banking or in risk management what you keep aside as a part of your capital or profit to manage any unforeseen risks which arises in future. This is provisioning, right? So RBI at that point of time was somewhat lenient on these deposits provisioning. So it became easier for them to deposit the fund. The banks were also able to manage these funds. If you know RBI would have increased the provisioning norms, banks would have raised the say rate of interest for lending. So all these complications would have been there. But still, what RBI did, easing out some of the risk provisions. So now when there is easing out of risk provisions, it becomes more easier to place your deposits with the banking system. Understood? If you talk about the present scenario, it is not that easy. But yes, continuously RBI is trying to monitor these regulations. So provisioning norms for project finance, as you see, 5% to be met is much higher than what is there the present rate. So these things are there which we have discussed so far. Yes, keeping capital for defaults. Okay. So this is the thing. This has also aided to more NRI deposits incoming towards India. So inward remittances, we would say. Inward remittances. Okay. Now, India has not been a contributor to global risk or uncertainty. So further the author says that India, if you see, given all these points, are you able to note something? That India is not contributing to uncertainty. We are very stable comparatively. Rather, we are protecting ourselves from the instability going around, isn't it? And that position, that strength of the economy is attracting all these things. More NRI deposits, more foreign currency reserves, more FDI, more FPI, more FII, all these things. It is the strength of the economy as compared to all the emerging market nations or the advanced economies. Right? This is the thing. Okay. I'll take up this question in the end of this class, current and capital account of BOP. Okay. I'll explain the difference in the end of this discussion. Now, such favorable growth keeps up these inflows higher in India. So, favorable growth is the reason that these inflows in India are higher. We are particularly talking about NRI deposits. That doesn't mean that other inflows are not higher. You already know that. In the RBI report analysis, we have seen every inflow coming to India is much higher as compared to the previous financial years, isn't it? Are you able to recall it? Yes or no? Right? That is attributed to good macroeconomic performance on part of India. GDP is performing good, core inflation is moderating, current account deficit is moderating. We have higher interest rates of attracting the foreign investors. All these things combined together. Right? Now, also NRI deposits are more stable than the capital flows into the equity. So, we have more stability in the funds now. Right? Also, there is another important concept which has been highlighted by the author that, one of the key determinants of these stable inflows. Why are they called stable? They are more stable than the inflows in the equity market. Right? So, one of the determinants of these stable inflows is India's interest rate differential has narrowed recently. Now, what is this concept of interest rate differential? Interest rate differential. You all know very well that Fed Reserve, the central bank of the US, also has kept the interest rates higher for a long time. Right? Indian Central Bank, RBI, has also kept the key policy rate higher for a long time. Still, we are expecting the policy rates to be higher. Now, what is this interest rate differential? It is the difference. It is the difference in your key policy rates with that of the advanced economies. So, if you compare the interest rate differential between what has been there in the US economy decided by US Central Bank or Fed Reserve and by the RBI, it has been, historically high. It has been. But now, so historically, there were differences of, say, from 350 to 400 basis points. Right? But recently that has narrowed down to around 240 or 245 basis points. Okay? To around 230 to 240 basis points. So this difference has narrowed down. Now try to understand why is it beneficial. You only will let me know if I ask you that this interest rate differential is higher. That would mean either of the interest rates, either of US's or India's, is much higher. Yes or no? Quick responses. Yes or no? Either of the interest rates are higher in that case if the difference is higher, right? Yes. Now say, for example, if US's key policy rate or the interest rates there are much higher than that of India, that would lead to capital outflow from India. Yes or no? Yes. That would lead to capital outflow from India. Agree. Okay. Now, if we are saying that this is narrowing, it means the difference between the US's interest rates and Indian interest rates has been narrowing. That means lesser capital outflow, isn't it? Because we are also on tight monetary policy stance. We have recently adopted withdrawal of accommodation. Again, we have maintained the key policy rates very higher. So that shows the difference is reducing. Once the difference is reducing, the gap or the capital outflow has also reduced. So now investors don't have much incentive to pull out their money from India if they are getting much interest rates on Indian securities as well. Have you understood this? Interest rate differential narrowing down is also one of the reasons. So now you see Indian interest rates are also attracting the capital inflows, and we might be responsible for capital outflow from some other emerging nations now. But being culprit for this is beneficial for the economy. Okay, that is not something like a criminal offense. It is something good on India's part. So India might be the reason now, that why there might be some capital outflows from other avenues, but that is not which we are deliberately doing. That is the strength of the Indian economy. I just want to say that. Inflow is also rising. Okay. So this is the thing. Now you see India's interest rate differential has narrowed recently as compared to the historic difference of 300 to 400 basis points which was there. Now the other reasons are, which are there. What do you want me to repeat? Interest rate difference. So see, simple. There are interest rates decided by India's central bank, interest rates decided by US's central bank. For example, there can be other country as well. Now there is a difference. Suppose US keeps the key policy rates higher because of inflation, but India does not do that. So there is a difference between the rate, right? Now where the interest rates are higher, investors will go to that country to invest because of rising returns, isn't it? So this is the rate, this is the difference in interest rates. Understood? Now if our country is also maintaining it to higher levels, the difference would be lesser. It would narrow down. Understood? Interest rate differential. Alright, moving ahead, rupee depreciation also has become more controlled on the backdrop of rising forex reserves with the RBI. Another reason which you can say why India is continuously seeing more inflow of funds is control over rupee depreciation. Now why are we saying control? Although depreciation and appreciation are market related phenomena decided by the market demand and supply of foreign currency, we are saying because there is a word called managed floating. Also that rupee depreciation or currency depreciation is favorable for exports of a country, right? They are favorable for exports, for promoting exports. Why? Because if your currency depreciating, you have to give more rupee for say $1, but you see from their point of view, $1 can now purchase more rupee worth of goods and services. So their demand of our goods and services increases. That's how exports boost. But depreciation is market driven. What we do is devaluation. I have told you the differences between all these terms, right? Devaluation is when our authorities deliberately try to depreciate the rupee is devaluation. When it happens automatically in the market is depreciation. So there is something called managed floating. RBI using the foreign currency reserves, selling and buying of the foreign currency tries to manage the value of your currency in the market. For example, if rupee is depreciating too much, which is harmful for the economy, too much depreciation is also harmful, right? In that case, what will RBI do? It will sell out US dollars, yes or no? Yes or no? It will sell out US dollars because once supply of the dollar increases, the rate will fall down. No, it is not open market operation. No, do not confuse it with open market operation. That is absolutely wrong. Open market operations are the selling and buying of government securities. Managed floating is selling and buying of foreign currencies. There's a clear difference between these two things. Okay, do not get confused. So this is the thing. Now you see rupee depreciation being stable. Why is it stable? Because now we have enough foreign reserves, so we can stabilize our economy. That helps the RBI in managed floating. That is another contributor, right? So this is managed floating. Managed floating, where RBI tries to buy and sell the foreign currencies in order to stabilize the value of our domestic currency. Managed floating. Okay. This is the thing. Next, NRI deposits have kept pace with India's economic growth, but domestic deposits are expected to outgrow NRI deposits. Further, the author is saying that now you are able to understand rising economic growth has resulted into more NRI deposits coming to India. But what we are expecting is also something different, that gradually, although they are rising, but domestic deposits will outgrow NRI deposits. That is another sign of a strength, isn't it? If your people are showing more confidence into the banking system, that means your banking penetration is rising. That means your credit facility is reaching to all the stratas of the economy. That means financial inclusion plan is working good. Yes or no? Right? So that is a good sign. You should have domestic deposits as well, because unless you have domestic deposits, they will not be you will not have good investment levels, because you know that it is the household savings which only are converted into investment via the banking channels. Isn't it? Household savings lying with the banks, not undercover savings. Okay, not under some clothes, under some papers, under some dibbas, not that saving. Saving which is deposited with the bank translates into investment for the economy. That is beneficial. So you can relate this point. If domestic deposits are expected to outgrow NRI deposits, tell me, it will boost investment levels for Indian economy or not? And once you are performing good on investment, your investment is rising both from domestic as well as foreign sources, your GDP grows. You will have employment, you will have more production, you will have more economic activities. Yes, this is something which you are already very sure now. In all my classes, I keep on repeating this chain reaction. AD increases, then this increases, then that happens, then that happens. So I am very much confident on your part that you know all these things now by heart. Okay. Yes. Yes. Moving more towards the excess capacity. That is the thing. Good. Now, further analysis, going into the further analysis, this is the thing. Domestic deposits are also rising. It is not that only NRI deposits are rising. So we are very happy on both the fronts, domestic as well as international front. Next point says, India has made a smaller growth inflation trade-off as compared to most of the advanced economies. This is also contributing to more NRI deposits, more remittances, more FDI, more FPI, all these inflows coming to India, more forex reserves, because India has been able to made a smaller growth inflation trade-off. Now trade-off, when you have to choose in between two things, is a trade-off, right? When you have to choose in between two things. So what does this point mean, that India has been able to make smaller trade-off in growth and inflation? Here comes a concept of Phillips curve. I have always told you that inflation is necessary for growth, and with growth, inflation comes along. You cannot do away with inflation if you want to grow faster, right? That's what the Phillips curve also says. So this is your Phillips curve. Here you have rate of interest in percentage, rate of interest, inflation, rate of inflation in percentage. Here you have rate of unemployment, not employment, unemployment, remember, rate of unemployment in percentage. And this is your Phillips curve. What does this curve says? Phillips curve. It was given by William Phillips. That's why the name Phillips. Phillips curve. So you can clearly see from this curve, here you have rate of inflation, here you have rate of unemployment, and this is a downward sloping curve which establishes an inverse relation between these two variables. So it clearly depicts that if, say, inflation rate was this, if inflation, say these were the points. Now you see, when inflation is higher, suppose this was the original point, E0. This was the original point, E0. This much is unemployment, this much percentage is inflation. Now suppose inflation increases, it has increased. Inflation has increased. Unemployment has fallen down. Suppose if inflation has decreased from here to here, you see from E0, this point to E1, unemployment rate has risen. So this graph clearly shows if you want to reduce unemployment, reducing unemployment means increasing employment simply. So if you want to reduce unemployment, you have to bear higher rates of inflation. Is it clear to all of you? Phillips curve. That's why we always say inflation is necessary for growth. You cannot reduce unemployment without higher rates of inflation, that is for sure. That is the trade-off you have to do. So you have to choose between these two things. If either you can have lower rate of inflation and then higher unemployment level, or you can have lower unemployment levels with higher rate of inflation. You have to choose in between. That's why this is known as inflation growth trade-off. Everyone understood Phillips curve, right? So it is downward sloping. One increases, other falls. Which crisis are you talking about? Which crisis are you talking about? Yes, we can say they are two sides of the same coin. They cannot be separated. But you know, saying these kind of statements for these macroeconomic aggregates, they have certain equations, they have certain calculations. So in that case, it becomes difficult to attribute these generalized statements in this case. Which crisis are you talking about? If you tell me the crisis, then only I can say. Also, when I say that this is the Phillips curve which operates, so it shows if you want to have lesser levels of unemployment rate in your economy, you have to bear up with higher rate of inflation. But that does not mean that it actually operates every time. It does not fail, but there are variations. It is not exactly adopted in any economic system you see. If you are talking about 2008-9 financial crisis, whatever crisis you talk about, crisis is something which is unprecedented. Everything changes. All the classical models failed during the Great Depression of 1930s. That's how the Keynesian model became famous after the 1930s. But these are certain models which exist. There can be ups and downs in these models, okay? Right? So this is the thing. I hope you have understood this thing. So remember the concept of Phillips curve. This is something which you can draw in your answers when you say that inflation is necessary for growth. You can substantiate, authenticate your point via Phillips curve. This is a very important concept in economics, okay? Now, so that's why the author says that India has made a smaller growth inflation trade-off. We didn't have to choose much between, inflation and unemployment rate. We have been able to manage these two things. Prudent monetary policies, prudent fiscal policies, continuous government intervention, monetary policy working well on its part have resulted India maintaining good amount of employment levels, not sufficient one I am saying, okay. So don't say that India has unemployment. Yes, I agree, but we have been managing to maintain it in comparison to inflation levels. Right? As economy moves towards inflation, as economy moves towards growth, inflation moves towards target, the growth momentum picks up and the deposits will rise further. Here the author says, we have seen all these things, India having a good growth prospect, more NRI deposits, we are managing well between the inflation and unemployment as per the Phillips curve, managing well on all macroeconomic fronts or aggregates. As we grow further and the inflation comes closer to the desirable limit, since RBI has kept the key policy rate higher, so it is expected that the liquidity will be managed very soon and we will be more closer to our desirable limit of inflation. When that happens, you will see these deposits will rise further. You will see these deposits will rise further. This is what the author says, because then India will have more strength economically, okay. Next, the author says these deposits in turn are leading to more stable and vibrant growth. So it is coming from both the sides. It is a win-win situation. Deposits are also leading to India's economic growth and India's economic growth is also attracting more deposits. So it is working from both sides. It is not unilateral, it is bilateral. Understood? Then the author concludes that given India's positive growth outlook for 24-25, which you all know very well via the RBI report that we have a good growth outlook for India in 24-25, this would further ensure that Indian economy becomes a favorable place for the NRI deposits to reside. Now you can connect this last line from the title which I gave to this PPT in the very first slide, isn't it? So that's why Indian economy will be a place where NRI deposits will want to reside, not the NRIs, NRI deposits, okay. So this is the analysis. Now I hope you have understood this thing, what all factors are working behind in making India more attractive avenue for all these coming inflows, be it deposit, be it investment, be it remittance. All these inflows are coming into India due to these several factors which we have discussed so far. Also, I got this question in between the analysis, difference between current account and capital account. So as I have discussed with you, BOP, which is the statement of your transactions with rest of the world, is categorized broadly into two categories, current account and capital account. Current account records all your transactions of goods as well as services. So it is basically the record of trade in goods and services. Services, invisibles, also called invisibles, right? So transfer payments, unilateral payments, one-sided payments for which you have not performed any activity are also recorded in current account. What is recorded in capital account is any transaction which leads to change in the ownership of the asset, recorded in the capital account. Recorded in the capital account. For example, investment. You do investment in Indian shares, you get shares. Ownership changes. FDI, ownership changes. Borrowing, asset changes. Asset liability status changes. So all these components which lead to change in the asset liability status or leads to change in the ownership of those assets are recorded in capital account BOP. Clear? I hope you have understood now. Any further questions from today's class? Have you understood this analysis, right? Crystal clear? Okay. If difference in interest rate of AE and EME is known as interest rate differential, then what is C? What do you mean by, can you please elaborate? What are you referring to when you are saying C, D, capital C and D? बस अब कोहिनूर वापस लाना है. Yes. That is true. Can you please elaborate what exactly you are asking, Rishabh? Otherwise, we will discuss this in the next class. See, we are not talking about the credit deposit. We are talking about the interest rate differential only. Credit deposit is something which gets affected by the interest rate. Are you able to understand? I am not going to the concept of credit deposit here. I am saying interest rate differential is this. Interest rates are not just for credits and deposits. These are in your money market, capital market as well. So it affects a broader range of money supply and money demand in the market. Referring to that thing, I am saying that interest rate differential is the difference between your interest rate, the key policy rates, and the key policy rates of some other countries. That can be an advanced economy, that can be emerging market economy, but particularly we are concerned with the advanced economies because it leads to capital outflow from our country. That's what I said, okay. Here that is something which is relevant, nothing else. Understood? Any further questions? You should try working upon your vocabulary, okay. That's all what I can suggest to you. Remember, always remember, whatever language you want to learn, vocabulary is important, because I believe if you know that सेब को इंग्लिश में एप्पल बोलते हैं, you will be able to say it. You don't have to learn speaking first, you have to know what it is called first, isn't it? That is the point. So work on your vocab, on your jargons, right? So let's wind it up, wind this session, and thank you so much again for staying tuned for so long and also staying interactive and focused. I'll see you in the next session. Till then, have a good day. Thank you so much.